And a very good afternoon, everybody. Welcome to the Horowitz Company pop-up Q&A webinar for August 17th, 2020. I'm Andrew Horowitz, and thanks so much for joining me today. I was thinking just earlier, I'm like, the summer is just about over. And I'm thinking, wow, that kind of happened really fast, and in an awkward way, it was kind of slow. I mean, this whole idea of having to be cooped up during the summertime, especially down here in South Florida, where it's hot as blazes outside, but it's a great time to visit the beach and do all sorts of things. The fact is that we are all involved in this whole situation where we have limited access to a lot of places and a lot of things that we used to do. And it's making a lot of us stir crazy. I know you're no different than myself. I'm no different than you. And it is a little bit difficult. Usually the time in the summer, what is it? It's time for vacations and doing things that are different throughout the year or different from throughout the year. So we're dealing with it. Hopefully this whole entire year, 2020, is going to be over soon. A lot of things have gone wrong. Pretty much the only thing that's gone right in 2020 is the stock market as to where we are now. And that's a good thing. However, there's a lot of other things that are obviously not so good. Hopefully you are doing well, your family's doing well, etc. Let me mention that, of course, this is only for educational purposes. This whole discussion does not infer a recommendation of any sort for any particular security. Past performance is no indication of future results. And some of the discussions that we have may touch on some areas that may appear to have some of the names of a company in there or maybe a sector, but again, not a recommendation. I want to make sure we're very clear about that because investing holds a lot of risk with it. You have to do your own research. You have to do your own planning, make sure you know what you're doing. So with that, I'll also mention that you can start anytime you want to ask any questions that you want. The whole purpose of what we're doing here each and every Monday is to give you an outlet, an opportunity to ask questions for what you may not be able to get answers to just simply by clicking in on Google and trying to understand what's happening without any context. So this is your opportunity. We did this for you to make sure that you have everything that you need that is, involved with what's happening now, because it's a much different environment that we have. We have, as we've talked about week in and week out, the whole idea of this dislocation of the markets and the economy. We have a very thick line drawn between what's going well and what's not going well. And it's very clear that economically, while we are seeing a healing, there is a lot of pain out there. A lot of people without work, questions about when and if we're going to see a renewal or any kind of additional aid by the federal government for the unemployment, and what's going to happen moving forward with people that are out of work. And if you're out of work, wondering, hey, am I going to get my job back eventually? Or is this whole COVID thing going to be a change to the entire economic backdrop, not only here, but around the world, and questioning whether or not we're ever going to get back to work. I talked to a few people today, two people in particular, who said that their jobs, while they are working, they've extended the work from home for another 6 months. So we're talking about it was supposed to end sometime around July. Then it went into, I think it was, the next one was I think it was October. Now they're talking about possibly March of 2021. I mean, it's just crazy. And then, the question about productivity, the question about being just absolutely stir crazy, dealing with being home for your work, being home for your dinner, being home for your lunch, and sleeping at your office and being at your office to sleep is all the same place, is very difficult. And oftentimes it can be depressing to a point as well. We know what that's about, right? I mean, you got to get back your life eventually, but right now we're not there. And as we move through August, where are we in terms of the business of the world, the business of stocks? So we're talking about the business of investing. Well, we know that we are very close to, just got up to the point of an S&P 500 all-time high. I know it's hard to believe for a lot of people that we are even close. And the NASDAQ up 20-something% for this year. The Dow is still down for the year. Small caps are still down for the year. In a lot of areas around the world, you look at any other developed nation, for the most part, they're all down for the year. But with the excessive amount of stimulus that was brought in, and the low interest rates by the Fed, the bond buying that we've talked about, all of this is really helping to maintain the levels of GDP if it were not for the lockdowns in this virus. Basically substituted for what we see with regard to what would have been from a consumption standpoint, and the government just basically took over. They took it over by actively pushing money into the systems, into the economy through unemployment payments and PPP and loans and excess monies and grants. All of that has helped to provide a very significant safety net for the markets. And we are now in the, I would say, pretty much the end cycle of the earnings season. So far, we've seen a pretty good earnings season from the aspect of what was expected to what was really the reality. Because if we talked about a couple of weeks ago that analysts have really dropped their numbers significantly, we saw that this low bar of earnings estimates that was put in, and companies really did a lot better, knowing that their year-over-year numbers could be cut significantly, and they were. Some companies lost 50% comparative revenue, comparative earnings from a year ago. But they did beat expectations. So now here, as we're coming to the end, the last big week for S&P 500 earnings, we have retail companies. We have Home Depot and Lowe's. We have Kohl's, Target, Ross Stores this week, and Foot Locker. So that's going to give us a really good indication of just how well the consumer is holding up, because these are the end cycle of the earnings season. And it's going to capture a bit more of the time period of when these lockdowns were on to when they were lifted, to the slowdown that we're seeing due to the fact that there's still a lack of people going back to work, and the fact that there is the concern over the unemployment compensation, the excess provided by the federal government that has basically been, it's right now zero. Yes, President Trump did do an executive order last week saying that we'll have a $300 plus $100, total of $400 if the states participate. We still have no clarity if that's actually happening. From what I've seen from people that I've talked to that are out of work, there's been no communication, nor have they received any money in the last week or so, because the week before was, or 2 weeks before, was the last period that they were eligible to get the federal unemployment compensation above and beyond what the state provided. So these companies that are going to be reporting, and a few others, are going to really give us nice insight into the resiliency of the consumer. And we know that people have been doing a lot of things differently. And in fact, crazy stuff is going on. Like, for example, who would ever thought that during a major recession, pleasure boat sales, private aircraft, and RVs would be so strong? The sales of these, just yesterday, I was speaking to somebody who works at a major sport fishing boat manufacturer. They are sold out, and the waiting list is the longest they've ever had. I talked to someone who is in the business of loans and lending for super yachts and for private airplanes, and they said business has never been better. So here we are in a very weird circumstance where the manufacturing component of our economy, a lot of the leisure, restaurants, airlines, transportation, are suffering and hurting. A lot of people are out of work in an incredible expanse of the workforce. Yet we are seeing that even so, people are going out and buying cars, where used car sales are probably the best they've been in years. And we're seeing that car sales are doing very well. And like I said, RVs, recreational vehicles, and what they're doing is diverting the money that they would have used for things like vacation, or for traveling, short-term traveling, or for maybe even going out to eat, because they're not doing that, to, hey, let's get a boat. So they're doing it because they have this idea that they're going to be cooped up for a long period of time, and they need an outlet. We all need an outlet, some way or another, whatever our hobbies are, whatever that we're used to doing isn't going to be the same for some time to come, unless, of course, snap our finger and we get some kind of vaccine. And that is not a panacea either. Because with that, there's a lot of question about, all right, who's going to be the first one to step up and take that vaccine that went through the fast track FDA approval process and not known what the side effects are, utilizing a standard phased process for approval, which usually takes years. Now, we don't have a vaccine yet. Yes, Russia says they have a vaccine. From everything that we could see, it's really a phase 1 trial that's gone on. There's been no, at least from what we could see, any nasty side effects, except for a fever, which they said is a side effect there. Now, over this weekend, I told you about a lot of things that I've been hearing about, but let me tell you a couple of things that were very interesting with regard to the storyline and the narrative for the markets. Because it was something that really, I thought, caught my eye, and you probably saw a bit about this, but there was a lot of moves done by Warren Buffett and Berkshire Hathaway. He put out some of his recent buys and some of his recent sells over the weekend, and here's what he did. He sold the bank positions. He had a significant reduction in his Wells Fargo position and totally eliminated his Goldman Sachs position. Held that probably since the early days of the recovery back in 2009. But what he did was really interesting. He put on a new position, about $500 million or so in Barrick Gold. Now, wait a minute. Warren Buffett, who never really liked the shiny metal, Warren Buffett, who, really didn't like technology for a long time, bought Apple and has done great with that. Warren Buffett, who really likes those companies that are cash cows and that are tangible, that are those companies like banks, like railroads, like industrials. Buying Barrick Gold, a gold mining company, what is that about? Now, the good news is we hold that in our portfolios for clients, and we've held that for a while, done very well with that and a few other positions, a couple of positions in the gold area. But Barrick Gold was up, I think, 10% or so today on this news. Why is he buying this? Now, recall, we've been talking about and discussing the idea of precious metals. I think there was 2 or 3 questions last week about precious metals. How much precious metals do I put in my portfolio? And I think we said something like, hey, 5% or so as a diversifier directly in, whether it's gold, silver, or maybe an ETF or maybe a mutual fund. Very good way to diversify a portion of your portfolio. Well, let's take a look at what's gone on and maybe give us some insight of what's happening with Mr. Buffett. Here, let's take a look at this. Well, first of all, let's kind of go back. Let's talk about, the dollar. As we are seeing the continuation of the Fed stepping in and backstopping and having an unlimited amount of money that they're going to push into the economy through the quantitative easing programs, through lowers in interest rates, et cetera, through the special Main Street lending program, the dollar has been falling. It dropped again today against a basket of currencies. Now, what's interesting about this, we got to go back to where 2018 to where the dollar is at this point. Still hasn't totally broken down to a point that you're worried about it, because I would say below 90. We're currently trading about 92, 92 and a half. But the dollar is very important when it comes to commodities. It's not an absolute correlation between, let's say, gold or oil for that matter, or for agricultural commodities. But a lot of things are priced in the dollar, and as the dollar falls, those prices go up. So you have gold against the dollar. In addition to that, why is the dollar dropping? Well, again, we see that the federal government's going to come in with, hundreds of billions of dollars, if not trillions of dollars, to the rescue as well. And our economy is healing. It is recovering, but it's not there yet. And in fact, we have the worst case of the coronavirus, it seems, from any other country around the world. And therefore, it's going to have a prolonged period to our economy heals. Now, what's happening is this is, again, good for some things, bad for others. It's bad for the purchasing power of our dollar, utilizing purchases of other countries' goods in the manufacturing process. However, it's a tailwind for many of our multinationals that are selling to other countries, and that's good. Now, it's also good traditionally for things like gold, silver. And now when we look at that, we'll jump to that chart and we see that here's a chart of the performance of Bitcoin, gold, and silver year to date. And what we're seeing here is that they've done very well. I mean, gold up to only 28% when silver's up 51% and Bitcoin's up 74%. What this tells you is that there is a concern about a few things. Number one, the debasement of currencies. Number two, slow economic recovery over a long period of time. Number three, it also looks at, there's concern about the dollar itself, maybe as the reserve currency. And finally, it does give us some insight into what people are thinking about inflation. Oftentimes you look for things like precious metals as an inflation hedge. Now, we could probably go back and debunk some of the long-term idea that gold on its own is a good diversifier, because we did see the couple of recent market drops. Gold was sold off as well, because it's not just that people are buying gold bullion. It's not they're just buying coins per se. They're also buying it on the open market through whether it's futures or even ETFs. And as people are looking to raise cash, they're going after anything they can when things are very tough. When you see a market that's in a severe distress mode, when you have to clean up things like margin, if you're on margin to buy things, you're going to find anything you can to sell it at any price in order to get out. And now, bringing this full circle back around, we look at Warren Buffett. If he believes that, number one, interest rates are going to stay down for a long period of time, it's going to be a long-term economic recovery. If, in fact, he believes that, then he'd have to say, you know what, maybe I don't want to be in the banks. This is the worst possible environment for banks. We need higher interest rates. We need better spreads. That's how banks make their money. And therefore, with all the trouble that they've had with Wells Fargo, maybe it's time to just ditch that. Listen, he got rid of his airlines. Let's put that into the equation. He felt that travel would never be the same again. He got rid of some of his banks, and now he's buying a gold-based company, a mining company. What this tells us, if it tells us anything from one of the best investors that has ever lived in terms of a long-term vision, because he's not just trading these things. You know, he's going to hold this for a long period of time. And if, in fact, his view is not just next week or next year, he's talking about, 10, 15, 20 years in the future, that he's going to be selling the banks. There may be a really long road to recovery. And the idea of putting money into the banks because they're down, until we see that recovery really take hold and the Fed stops pressing their stimulus into the economy and depressing the real rates of return, well, maybe that's one of the reasons that Warren Buffett threw in the hat and said, you know what, I'm done. And you know what? I think there's going to be inflation. So there we go. And is there inflation? That's a question you have to ask. We saw the PPI 2 weeks ago come out very hot. Last week, the CPI, the Consumer Price Index, come out pretty hot. But both of those were on a month-over-month basis, and basically it was in a recovery structure. If we look on a year-over-year basis, both are still pretty much below what I would call trend. And in addition to that, the biggest component of that increase was energy. People going back out and driving a little bit drove the price of oil and gas up. So if we take out energy, which you can't because it's part of the CPI, but if we did, really everything else is holding solid, not really moving. So what else do we have ahead? Let's see. Markets no longer seem to be really reacting to the virus news. It seems to be the Fed put, fiscal stimulus is really what it's all about. And even that, nobody seems to care, because right now we're in a log jam. We're in an absolute stall when it comes to the next potential stimulus package by the government. Democrats, Republicans can't agree on anything, much less this package. They did the one package when they thought the world was falling, and they were easy to get that through, and it was obviously excessive. But now the continuation of new payments and benefits seems to be stalled. I think maybe focus on the election could come up, but there's a lot of confusion now about this and worry about this mail-in voting and what's happening with the Postmaster General and what's happening with mailboxes. And I can't honestly, if we try to keep up with this story, it will be gone before the next story pops up of some other crazy situation that's going on. But I think it's all about trying to confound, confuse, disturb, and make it so that it makes almost the decision-making process either absolute that, yeah, I'm voting for Trump, yeah, I'm voting for Biden, or maybe so confused that I don't even know what to do now. I think there's a lot of that going on, and I think it's purposefully being done right now so that the masses are confused and that there is a question as well, do I do mail-in voting? And I don't want to, but I have to go in. I don't want to go in November. It's going to be November. Maybe I can vote. Maybe the virus will be dropped a little bit, but I don't want to take the chance. I have been good all this time and I haven't caught anything. I've been safe, and now I have to go out and vote and stand in line next to other people in a voting booth that they were just there breathing on, touching. Very difficult situation. We could bring up voter suppression and all. Again, I don't trust any of the information I'm getting right now. And again, I think that is very telling. I think it's not so much, I don't think it's only me. I've talked to a lot of people. You know, all the information that's seemingly coming out of the news from any source right now is just not believable. Not so much market news, because market news we could check and we could look at the numbers, we could figure out what it is. That's easy, right? The fact checking on that is very easy to do. But there's other stuff about voter fraud and mail-in ballots. And all, I mean, I get where the problems are, but yet, you know, maybe we could just go absentee and that's better. But we're confusing the point of absentee and mail-in. So that's a big issue that's going on right now. So market's going to be looking to that. Fed minutes this week as well on Wednesday. So there's a lot of things that could shape market direction. But the question is, will it? So far, the market is pretty much blown off the idea of concern about the economy. No longer cares about the virus and direction of what's happening there, because everybody believes that, hey, everything's just staying open no matter how bad it gets. There's no concern about the earnings drop that we saw on a year-over-year basis, figuring everything's going to get back to normal, back to where it's going to be. There's no concern about the election either way. When Joe Biden announced his running mate, everybody was kind of like, okay, well, we thought the Democrats were going to be bad. That was the narrative out there. Well, as soon as he announced it, the market went up. So maybe Democrats are good. I don't know. And we can go back in history, and history tells us it really doesn't matter who's in the White House. But it seems like there's a bit of euphoria and a bit of, well, irrational exuberance, I would say, in the markets right now, that there's nothing at all. An earthquake, a typhoon, some crazy event somewhere in the world, protests, you know, nothing seems to bother the markets right now. And that's a good thing. You know, that's strong that the investors are willing to take their money and put it down and obviously, you know, bet on, if you will, that things are going to be in good shape. So let's get to some questions here. Let me mention something that you can ask your questions in the Q&A. There is a Q&A panel at the bottom. Probably you can see that. You can click on it and ask your question. And we'll go for as many questions as we have. I'll mention to you, as I always do, and I think it's really important to recognize that, you know, this is for you, and anything you want to ask about maybe something that's going on, your thoughts on the markets, you're concerned or you're happy. Should I be happy? Should I be scared? Whatever it is about a particular sector, an area in finance, even tangentially related to what we're talking about, this is your opportunity. This is why we're doing it, to give you that, you know, that the chance to ask that question, which maybe you usually couldn't do so. All right. Let's get to some of these questions. First one. Steve asks, with almost within parentheses, almost no interest on cash held in banks, I'm considering investing about a third of my cash in equal amounts into 4 or 5 high yield, over 5%, beaten down large cap companies in order to generate some income. What major issues should I consider? Good question. So there's a variety of things that you may want to consider because you're using this as an income alternative, right? So you're not really necessarily telling me you're investing in stocks because you like them. You just like that their yield is really good. Now, one of the things you want to look at is what's their income and do they have enough coverage of their dividend? So what I mean by that is this. When you look at net income of a company, and let's just say that it comes in at $1 a share, yet they're paying out, I don't know, 50 cents a share in dividend. Well, they have enough interest coverage to, they have enough coverage of their income to cover their dividend, right? But what if a situation occurs, and you can look these numbers up, the dividend coverage? What if the company has $1 of earnings, but they're paying out $1.50, or they're paying out 98 cents and the earnings may go down? Or what chance is it that this company may have to, I don't know why, so you asked me what issues you could consider. Is there a possibility that they're going to cut their dividends? Now, you're talking about beating down stocks. And when you talk about beating down stocks, which have yields that are very high, there is a chance that they may want to conserve some of the capital. So maybe they drop it to 4% from 5%. That could be a very big issue. Now, with that in mind, you have to realize that the stock will go down. So here's my big issue with this strategy right now. Not that you're not going to find good companies, but here's the deal. You just said to me, this is the question you asked. You said these are beaten down companies. Well, the stock market is almost back on the S&P 500, back to its all-time highs. The Dow Jones off a few percent. Okay. A lot of recovery took place here. Why are they still beaten down? Number one. Number two, if they're beaten down, what makes you believe that they're not going to get further beaten down? Because all you need with a 5% yield on the stock is for the stock to be down 5%, and then you just wiped out your yield. Now, if you're willing to hold it for a long period of time and it comes back and it's not a company that you have any concern about going under, defaulting, or all, okay, that's one thing. But if it is a company that is having stress, look what kind of debt they have to their equity. Look at that ratio. Find out to make sure they don't have so much debt outstanding that it's going to cause problems over time. Make sure they have dividend coverage of their earnings, and make sure that it's a company that you feel that actually, maybe beaten down now, but has some opportunity in the future to move higher. I think that's important. Okay. Jack has a question. Okay. Besides low interest rates, what are the factors to purchase TLT? That's an ETF, by the way, the long-term 20-year plus Treasury ETF. It buys bonds, weak US. So his question is it a weak US dollar, safe haven? I like to move my portion of my IRA to TLT, and I'm looking for an opportunity. Thanks. Well, the main issue of TLT is, I would say, not much of the above that you asked. I think the question is, where are interest rates going? Now, if you tell me that, I can tell you if it's a good idea to buy TLT. Interest rates have been on the decline pretty much if you look back in time for the last 10 years. As interest rates go down, bond prices go up. So right now, the major component of TLT's overall performance, or bond funds for that matter, or bond ETFs, have been the fact that the underlying principal value of the bonds have been going up because people are willing to bid higher and buy bonds because there's a chase for yield, even though they're dropping the yield down to levels that we haven't seen, well, pretty much ever. So it is a safe haven to a point, but realize if we start getting inflation and if the Fed takes their foot off the pedal and if, in fact, bond yields go higher, you're going to start accumulating losses in TLT. Look what happened last week with these bond funds. Interest rates spiked last week pretty well. The 10-year went from 0.55 to 0.7. Now, that may not seem like a lot to you. That is tremendous. And we saw the same reaction in a lot of bond funds. And this is one of the longer bond funds, and this will have a lot more, I would say, variability. Because if you think about, I want you to think about a seesaw. Okay, you got that picture of a seesaw? So with a seesaw, what happens is, let's see if I can, all right, I'm gonna write, okay, let's see if we can do this. Seesaw, I'm writing here, okay? Or, let's say an X, right? Well, down here is rates of a bond, and up here is the price. Okay, when the so this is yield, this is price. Hopefully you can see this. When yield starts going up to here, price is going to do what? It's going to come down. So it is an inverse relationship with price and yield when it comes to bonds. That being the case, the question again I ask you is, where are yields going? Are yields going to come down a lot? Are they going to stabilize? Stabilize, great. If they're going to come down, that's great. But if the long term has the potential to move higher, you could have a problem with a long term. And more importantly, one last point: the longer you are with your bonds, the more potential volatility you have. Longer bonds will have usually greater volatility, and when you associate it to an interest rate move than the shorter term. That's why our portfolios, for our global allocations and for our investology, we have a much shorter duration overall than we would usually have. We still pick up some decent yield. We still pick up some decent return, but we don't have to worry about the potential of a spike or an event that could increase. And that's why we saw last week inflation was on the mind of people thinking maybe the Fed will back off a little bit, which is not probable. And we saw that yields came up and the price of the bonds came down. All right, we could, by the way, just load your questions up. We have about 2 or 3 more questions here. So if you have any questions at all, use this time to your benefit. Aaron says, or asks, I understand Mr. Buffett controls everything. Not really. Elon Musk, maybe. No. But is it possible he has looked at his stock prices, now listening more to the younger money managers and taking their advice? I mean, look at the Apple position. Thanks. Yeah. Well, yeah, I think so. I mean, for a long time, Warren Buffett said, I don't know anything about it. I remember this back. This is early 2000s. He doesn't know anything about technology. He doesn't understand technology. He's not going to invest in technology because he doesn't invest in anything that he doesn't understand. So fast forward a number of years, he took on a big position of Apple, which has been one of the best positions in his portfolio, clearly, for the last year and a half or so. Now, remember, Apple's not a far cry from what he usually does, right? What he looks for is cash cows, those companies that are buying back shares like IBM, like banks, those companies that are almost too big to fail to some degree in some respects, but also those companies that have consistency of revenue stream. And that's kind of Apple. Not much different than the banks, not much different than kind of the railroads, unless you enter a time of significant economic stress. Now, right now, the economic stress that we should have had, the ability for people to buy iPhones, probably was a situation where Apple shouldn't be doing this well. However, everybody has, or I should say nobody has anything else to do but to see a window to the outside world. You have a little screen or a big screen helping you to really see what's happening. Instead of opening your door and going outside and seeing what's happening out there, you know what? You just pop open your phone and see what's happening. Instead of seeing your friends, you're using FaceTime. So the world right now, and you're not making phone calls, you're texting or you're emailing. So he utilized that as a very smart move of his to really capitalize on that. It could have gone either way in this circumstance, but it obviously really benefited him with this. But yes, I do think he is starting to listen more to the younger money managers within his firm, because one day he's going to retire. Another question. I have about 50% cash. Is there any better place or fund to be in with on the sidelines? I have an Ally. I do have Ally Bank at 1.9%, but it's currently 1%. Oh, you did have Ally. Oh, I did have Ally at 1.9%, but it's currently at 1%. There's not much you could do about that. There's no money in cash. There's really, I think that there is, I'm kind of thinking through my head right now what the options are. This question comes up a lot, but I still no answer. When you have interest rates as low as they are with the zero interest rate policy by the Fed, there's not much you could do about that. And if you want the safety of cash, and that's what you're looking to do, with the belief that if I have cash, I can't lose money, well, your fee is going to be the fact that you have, a certain amount. If you're using cash, as we've talked about, to be 1 foot in, 1 foot out, to get that, opportunity to eventually get back in, because you're concerned now, well, I don't think it's the biggest deal not getting much interest rate on it. If it is permanent cash, that's a problem. If it's permanent cash, and depending on how old you are and what your outlook is, you really need to rethink what you're doing here, because you want your money to work for you as best as possible, a smartly, and effectively, but also in a way that you're comfortable with. And obviously, with 50% cash, it may not be very comfortable, but still, there are probably better alternatives that maybe are not necessarily risk-free, but it's all about the time frame. All about the time frame. So to answer your question, no. I don't know if anywhere else you can get better than 1%. So 1% seems to be actually a gift right now. Wow, a lot of people in the room today, but not a lot of questions. We have one more. So if you have any others before we close this out, you should get it in. Hal says, when someone buys $530 or $563 million of a stock, does this mean there's a flooring of a price? Well, remember, he probably bought it before the price went up today. So I guess it could come back. But with the idea that, here's the idea. So when you see that there's a big purchase of a stock by someone like Warren Buffett, who is a very conservative investor at heart, and he's going to a new area that he's never been in, really, to speak of gold. I mean, that kind of perks your interest, that what's going on after they probably went through the mill doing research, went through all the books, all the records, spoke probably to the company also, jockeyed it around at meeting after meeting after meeting, and then they still have a major investment like this. Something's going on. One of the things you could also infer is that they're going to put more money into this and try to really buy this. The other thing you could infer is what other companies in the same sector are ripe for an investment. So this is something that a lot of people are thinking about, and why the entire sector got a lift today in the gold shares. So there is a floor to a point, as long as things go well. You have to understand also that he may go in there and work with the company on trying to enhance shareholder, the opportunity for shareholders. And what that means could be is buybacks. It could be dividends. It could be just a whole host of accounting. So, there's an opportunity there. All right, Douglas, last question. Easy question about income stocks. Are dividend distributions included in EPS? Are dividend distributions included in EPS, earnings per share? No, it's going to be, it's just the earnings. It's just it depends on how they're doing it, what you're looking at here. There's different ways of looking at this. Straight EPS, it's not included back, if that's what you're asking. It's just earnings. It's the earnings, the net earnings of the company. So, not sure if that's what you're asking. I hope we answered that. I'm not sure. Anyway, we'll be back again next week. And if you have any questions, of course, Tuesdays, you can listen to us on DH Unplugged. Fridays, the Disciplined Investor, or Saturdays, the Weekend Disciplined Investor. We had a good guest this week, a Fed insider on the Disciplined Investor podcast. So definitely listen to that. But anyway, we'll have this recorded. We'll have it up on the site in the next day or so. I want to thank you for joining me. Go out, have some fun, have some safe fun. I don't know, go buy an RV and send me a picture. Love to see it. Anyway, I'll see you next week. Thanks.